Many of us want to invest in mutual funds but are unable to decide which one to invest in. Well, technically, your life got just a little more complicated. There are as many as 20 new fund offers out there that are open for subscriptions. These are multi factor funds, multi asset allocation funds, balanced advantage funds, thematic funds such as manufacturing, innovation focused funds, etc. So, how do you decide which ones to invest in? Well, don't worry. Today we have with us Kirtan Shah, founder of Credence Wealth, to help us understand how you can consider these new fund offers, which one to invest, which one to skip. Hi Kirtan, coming straight to the point. We wanted to ask you, there are so many new fund launches out there right now. There are funds that are unique to the industry, that are industry first, and then there are funds where the fund houses are new, but the funds are still the same in the same category. So, how should investors look at these new fund offers? Uh, and do you think they should skip it or they should consider some of these funds?
Just first, thank you so much for having me on the show. I think there are three angles to this conversation, at least the way I look at it. First, retail investors have to understand that buying an NFO at 10 rupees is no advantage, right? I think it's a myth that keeps circulating in the ecosystem saying that it's cheaper and hence it's easier for that 10 rupee to become 100 rupee. Everything in finance is in percentage terms and the NAV actually practically does not matter. Now, first, what you have to understand as a retail investor is what do you really need given your risk profile, time horizon, and the goal that you are trying to chase. Does that new fund actually has place in your investment ecosystem? You don't want to invest into something just because it's new and it looks fancy, even if it's a great investment product to invest in. So the first thing, in my opinion, that the investor community has to really understand is the new fund offer solving a problem that you really need in your portfolio from a asset allocation standpoint, goal standpoint, or anything else? If it does, then you definitely want to look at it. Now, while you are looking at it, there are two further discussions here, right? That if there is a new fund house launching a fund, do I really want to risk into something that I have absolutely no background about? When there are probably tens of other investment in the same ecosystem, same category available with 10 years, 15 years, 20 years of investment horizon. And I know how these funds did when the last 4 times the market fell, right? This is a conscious call that if you really ask me, I would say I would rather want to stick to a fund that has been around for the last 10, 12, 15, 20 years because I know that how did the fund really ride through the various ups and downs that the market had versus trying to predict or imagine that the new fund will really be able to do that, right? But if there is a new fund offer which is new to the industry, it does not really have a precedence set by somebody else, then you definitely would want to look at it in the tactical side of your allocation because probably that's where it might fit and not fit in your core, but it can definitely fit in your tactical allocation. And you would want to definitely consider looking at it because you've not seen something like this similar in the industry and it might end up solving some problem that you are really looking at solving in terms of your investment. So these are the three aspects I would suggest that a retail investor looks at before deciding whether do you really want to jump into an NFO or not.
Right. And now we have seen so many new fund launches. We are seeing multi-factor funds. We are seeing passive funds. We are seeing equity funds, debt funds, and different kind of funds out there. U.S. Treasury fund. Uh, so, in what circumstances can an investor consider entering into a new fund? Can you be a little more specific? Can you give some guide points where it makes sense?
Just so the first thing that we really have to understand is 2018 the SEBI categorization rule does not allow you as an AMC to come up with a second fund in the same space. Now there is some ambiguity or I would say free space here where in thematic you can jumble around and come up with a new fund. You can do something from a global market standpoint, which is why you see that all the kind of funds that are now available or now coming as an NFO is not going to be your normal flexi cap or a mid cap or a small cap because all of those categories already most of these fund houses have, and they are not allowed to have a second fund in that space. And in that context, you are going to see some innovation definitely in the NFO space. But I mean, I keep telling my team quite regularly that 9 out of 10 times, if there is a new NFO coming in a particular theme or a market cap, that's the time you really don't want to touch that theme or the market cap. Is because look, please understand from a manufacturing standpoint, you want to roll out a product either when there is a need or when there is too much of demand for that market cap or theme, right? So if the NFOs come out because a particular theme's played out or a market cap has played out, and hence you come up with either a passive or a thematic in that space, it makes no sense, right? But if there is an opportunity that you can play, but it's not available to you right now, is when you definitely look at the NFO. Like say for example, you made a mention of the US treasuries. Now we know that globally interest rates have topped out, and most probably interest rates will fall probably from the June quarter onwards. And that is exactly where you can tap into investments on the fixed income side. The longer the duration, the more capital gains you will make. And we don't have a lot of US treasury, US bond related funds available in the debt space. And hence, if that NFO is come up with at that particular time, it's an opportunity that you are trying to tap into, and it can be brilliant, right? I think there are funds where you are trying to do two global themes together, like the Indian IT and the US IT. Now, a lot of us probably have been doing both of these things separately, but because of doing these themes separately, we have to end up taking a huge exposure to the US technology side, whereas what is really working is only 6-7 stocks in the US. So a solution where you focus on Indian IT but add those 7 stocks may end up doing well. So I think
something like a factor variation may
will
work
definitely
in some cases.
Will definitely work, right?
That can add value in some cases.
100%. So I'm saying that if you are coming up with a small cap fund because small cap has rallied, or if you're coming out with probably something to do with PSUs because PSUs have rallied, or you coming out with something in the EV space because EV is the buzzword and everybody is talking about it, you might not be at the right time to invest because that theme would have temporarily kind of played out. But if you come with something that can play the theme that is now developing, right, probably that's the NFO for you to really look at.
Right. And what about new fund houses out there now? There are fund houses that are only going to be passively focused.
Yeah.
We are seeing some new kind of products coming from them. Then there are some fund houses that are talking about creating portfolios that are very unique in the industry with no overlaps. What about these fund houses? Probably in some cases the fund labeling may be same, but is there a differentiation there? Should investors look at them, or should then again wait and then look at it later?
See, I think just that largely depends on what category are they trying to work around. If there are funds, or if there are AMCs who are saying that they want to build products in a way where there is no overlap, I think it can be a brilliant product to participate in. Is because today the biggest problem in the mutual fund community is that a retail investor ends up taking 12, 15, 20 funds in the portfolio, where she feels that I'm diversifying by investing into 4 mid-cap funds and 4 small-cap funds, not realizing that most of the portfolio is overlapping. So I think if there is somebody who's trying to solve this problem, right, should definitely work. Why not? Right? But if there is going to be a smaller or a newer player, smaller may be the wrong word, but a newer player who's trying to do a flexi cap or probably a mid cap or a small cap, I would rather say that I have multiple other options to really look at, unless you are getting a fund manager on board who's got a track record in the same space of having delivered the right risk adjusted returns for years together, then you would definitely want to consider, is because it's just a hat change that the fund managers had from the old AMC to the new AMC. But if the fund manager has not been around in the MF ecosystem for a long time, the fund house is new, and the category that they are trying to come up with is very similar to what the existing opportunities are, then I am somebody who believes that I would want to really stick with some gray hair that we've already seen than trying to back something.
Right. Some of the uh, new funds are actually new fund houses are actually being launched by old fund managers.
Correct.
So we are seeing some movement there. Now, going ahead, we probably this is not the end of it. We are going to see more launches. So, how many funds do you think are enough for an investor to have in their portfolio? Whether it's multi-asset allocation, which offers diversification across assets. Of course, hybrid funds, equity funds, debt funds. How many funds are good enough?
I think that's a very interesting question, and let me answer it this way. If you are somebody who's wanting to take a bet using SIPs, I don't think you really need more than 4 funds in your portfolio. I am, I have enough and more data to back when I say this that if you invest money in large cap, mid cap, small cap, and some allocation to global, but make sure that while you are doing this, you have incorporated growth investing style, value investing style, and a little bit of momentum, you will be able to beat Nifty 500 with a decent risk adjusted return.
Okay.
Right? But if you're somebody who's going to take lump sum bets, then you will have to be very conscious of the fact of when are you investing that money. Right? So let's say today, if you ask me that you've got 100 rupees to invest, I would rather want to focus more of my money towards large cap than wanting to do towards mid and small. Right? So lump sum is a game where you got to get your timing correct. Of course, 10 years later, when you and I will talk, the same individual, irrespective of whatever mistakes he would have made, would still end up making some returns. But not every investor will really be able to ride the volatility that is required for him or her to stay invested for 10 years. And hence, lump sum requires a little bit of timing. But I am somebody who believes that if you are a aggressive investor, have 80% in equity, 20% in fixed income. If you are somebody moderate, do 60% equity, 40% fixed income. And if you are conservative, have 20% equity and 80% fixed income. A very contrary approach. I am not somebody who believes that gold plays a very significant role in your scheme of things in terms of asset allocation.
And why is that?
For me, gold is extremely lumpy.
Okay.
Gold actually ends up behaving like equity in the short term when the macroeconomic situation does not favor it. Of course, in the short term, because it has negative correlation and equity falls and gold goes up, there is a theoretical balance. But I'll tell you why that theoretical balance is not very practical, because any and everybody that you talk to in our ecosystem will say have 10% allocation to gold. Now, if 80% of your money is in equity and you have 10% in gold, and if equity has to fall, what balance are we really talking about? That can largely be done by 20% fixed income also, right? So, I think as an aggressive investor, the reason why I suggest that you have 20% in fixed income is not from a fact that it will balance your portfolio when markets are falling. My reasoning to have 20% in fixed income is because every year you have opportunities that you do not capitalize on. So to give you a data, in the last 44 years, there have been only 4 years where intra-year the market has fallen less than 10%. In the last 44 years, 40 years markets have fallen intra-year more than 10%. But every time the market intra-year falls 10%, most of us do not have the money or the courage to invest that money in equity, in spite of seeing it happen for the last 44 years.
Intra-year is basically during the year.
During the year.
Right.
During the
The
year.
max fall.
Max fall. Right? So my logic for an aggressive investor is not that the 20% will really balance your portfolio. It does not. Right? But you can actually use this money to buy market when it falls more than 10% in intra-year. You keep doing that every year, I think you will end up beating the best of the fund managers or the money managers in the market.
Right.
So yeah, that's my way of looking at.
Right. But of course, you would need to keep some funds on the side for your short-term goals.
100%.
Right. Like some of us who now have kids at home, thinking about their school expenses, etc.
No, no, 100%. I
that,
think just first what you actually do is before you implement my last answer, I think the first thing that you have to do is have 6 to 12 months of emergency corpus made available. Because you don't want to be in a situation where if you've lost your job or something's happened, you are struggling to meet ends, and that's not a good site to be in. And I'm also somebody who believes that as soon as you are 12 or 18 months closer to the goal for which you've been investing, start moving your money from equity to fixed income, because you don't want to be in a situation that 2 months before reaching your goal, markets tanked and all the money that you've accumulated over the last 10-12 years falls by 20-30% and you are not able to use it for the goal. So I'm definitely somebody who believes that you should use fixed income extremely prudently for your goal-based allocation, emergency corpus, but at the same time, as an aggressive investor, also use it to buy the markets cheaper whenever you get that opportunity.
Great, Kirtan. Thanks a lot for joining us today. It was indeed a pleasure having you here.
Always a pleasure to be a part. Thank you so much.
Hope this conversation helped you understand how you should look at new fund offers being launched by various mutual funds. For more such interesting conversations, keep watching Mint.